All right, team, what's up? Welcome back to Walks on Wall Street. Hopefully everybody is having a fantastic day. It is Wednesday. It is February 22nd, 2023. It's about 8:57 p.m. We're getting a little bit of a late start here, but I do want to apologize, guys. My bad. I dropped the ball. I was late. But I do have some news for you guys as to the reason why I was late. I was actually I went to my friend's restaurant. Sometimes you got to drop things and do some stuff for your friends. And, I went out to my friend's restaurant. I supported him and his team. And let me tell you, amazing. 10 out of 10, 5 stars, whatever they give it. That's what I'm giving it. If you want to check it out for yourself, I would highly recommend it. The restaurant is called Mel's, okay, M-E-L-S. MELS, and it is right near, 16th Street, 10th Avenue. So if you guys are ever in the city, please check out Mel's. But let's just do a quick market recap here, everybody. So today was a little bit of a mixed day on Wall Street. The Dow Jones Industrial Average was pretty flat. It closed down about 84 points, which is less than 0.25%. If we take a look at the S&P 500, that was also roughly flat, down 6 points. Now, I want you guys to notice something here. Whether you have a Bloomberg terminal, whether you have MarketSmith or TradingView or whatnot, notice where the market is correcting back to. If you look at the S&P 500 as of today, we're sitting right on the 50-day moving average. Okay, so assuming that 50-day holds, hopefully, I think this, choppy trend is still intact. But as you know, if we start to break back below those major moving averages, that could be a very significant problem. Let's take a look at the NASDAQ composite today. That was up 14 points, but pretty much flat. And the NASDAQ composite is correcting back towards its 50-day moving average as well. Let's quickly do a recap of what we talked about yesterday. For those of you who don't know, yesterday was a very important day, very important live stream if you want to go back and rewatch it. We were talking about the National Association of Realtors as they released their existing home sales report for January, okay? And existing home sales declined yet again 0.7% in January, and that marks the 12th consecutive month of existing home sales declines. The median existing home sales price actually increased on a year-over-year basis to $359,000. And I guess on a positive note, depending on which side of the housing market you're on, inventory actually grew a little bit. So inventory for existing homes grew from the prior month to about 980,000 units at the end of January. That's roughly equivalent to about 2.9 months of supply. The reason why I wanted to recap that for you guys is because today, we had a big name in the home builders sector reporting, and that is Toll Brothers. Now, we're going to do a deep dive into Toll Brothers' earnings report today, but they did beat both on the top and the bottom line. And the CEO of Toll Brothers actually gave us some pretty interesting insights into the health of the new home sales market. So I think you guys are going to appreciate that. We're going to talk about Wingstop. Yesterday we were talking about Wingstop. I think it's an interesting bull thesis there. They did beat on both the top and the bottom line. Earnings exploded. Talk about a rip your face off earnings beat. Earnings up 155%. EPS came in at 59 cents on revenue of about 104 million. Revenue was also up about 46% quarter over quarter. So pretty good. We'll talk about Walmart and then we'll quickly check interest rates. But team, let me go ahead and pack up my computer here for a moment because I'm a little bit of a mess. I was running around like crazy in the city. So just let me pack up my stuff. We'll say hello to everybody in the chat. And today we are going to be commuting to Penn Station because I got to go home. So it's probably going to be a little bit of a shorter stream, maybe about an hour, maybe an hour and a half if we're lucky. And I think it's pretty cold out too. I was outside earlier. It was probably 34 degrees, like this misty, nasty rain and wind. So hopefully you guys are all bundled up, because I know I am. All right, let's see who we have in the chat. I see Nina. What's up? Good to see you. Lena Sandoval. I see John. Hawaii is in the chat. Good to see you. FredX. Always a pleasure to see FredX. Let's make our way to the elevator. But how you guys doing? Already halfway through the week on this President's Day shortened week, so hopefully you guys are having a good one, completing some tasks, keeping it positive, and succeeding in whatever industry you're in. Now, I'm really excited about this stream today because we're sort of seeing the housing market is so strange, and we're going to talk about it. But let me hold that thought because the internet is a little bit crazy here in the elevator. So I'll see you guys on the other side. You guys deal with all this. Hopefully it's not raining, please God. Really not looking forward to walking in the rain tonight. But we are going to walk to Penn Station, and we are going to commute directly through the belly of the beast, which is Times Square. Very, very seldom do we ever walk through Times Square, but here we are, team. We are outside 57th Street, Billionaires Row. You know, this is my favorite sort of neighborhood in the city. Take a look at how cool the buildings look tonight in contrast with all the clouds. Now, I like to call nights like this a classic Gotham City night. You can see how tall Central Park Tower is. It is literally in the clouds. You can only imagine living at the top floor. You know, if you are interested, the top triplex of Central Park Tower is actually on the market for a cool $250 million. And I think the monthly property taxes are just shy of $100,000 per month. So maybe if me, FredX, and maybe Dusty Cole chip in a couple bucks, we'll be able to close the deal. All right, guys. So you all know what happened with existing home sales, right? We talked about it ad nauseum yesterday. Now, we can use specific corporate earnings as a proxy, okay, to gauge the health of the new home sales market. Now, Toll Brothers reported earnings today. They reported earnings per share of about $1.70 on revenue of $1.78 billion, okay? Now, let's quickly talk about the guidance. They kept guidance the same, so there was no change. They guided to about $8 or $9 of fiscal year, full year EPS on gross margins of 27%. Now, again, this is not an analyst's guide. This is what the company, Toll Brothers, is putting out as their guidance. That's pretty good, because if you think about what earnings were last year, okay, fiscal year 2022, real quick, hold that thought. For those of you who are unfamiliar with the neighborhood, we are walking directly down the street from Carnegie Hall. This is one of the most famous places probably in the entire city. And I have very fond memories here at Carnegie Hall, and hopefully pretty soon they'll take all this nasty scaffolding down, please God. Hopefully by the summer when we're doing these live streams here, we'll be able to see the gorgeous building without any of this scaffolding all over the place. Anyway, so 2022 earnings in terms of EPS for Toll Brothers was $10.90 on 27.5% gross margin. Now, notice the environment we were in this time last year. Completely different interest rate environment, right? We've talked about this, we really don't need to review it again, but interest rates have gone one way, and that is upward, that is skyward. And I actually think that they're probably going to go up again as it relates to that 30-year fixed rate mortgage, because we are having a major bid in that 10-year U.S. Treasury yield. I think as of recording this video, the 10-year yield is 3.927%. It is knocking on the door of 4%. But the management of Toll Brothers on the earnings call seemed pretty confident that they would only have a very, very slight earnings erosion for this entire fiscal year. If you think about 2022, they earned $10.90 a share. This year, they're expecting about $8 or $9, and not much margin erosion. Now, this is assuming we take their word for it, right? Really quick, this is the Central Park Hotel. This is actually a pretty nice hotel. I've stayed here many times. The lobby, totally remodeled, really, really beautiful. Hey, Sally is here. What's going on? Ryan Beck, good to see you. Now, I think I saw a comment from Ryan a little bit ago that says you just went under contract on a condo, dude. That's awesome. Well, congratulations on the deal. I'm trying to find where that comment is. Maybe I'll have to go back and look again. Let's see here. Hey, Richard Vogel, good to see you. L the Original says, is it expensive? I think per night you could probably, I'll give you guys a tip. You want me to give you guys a little tip? So if you're in New York City, okay, and I do this all the time. Let's say if your meetings are running late, or if you're doing a live stream and you're running overtime and you miss the train, okay, this is what you do. You download this application, and this isn't sponsored. A lot of people, anyway, I'll digress. Nothing I say is sponsored. Nobody pays me to say anything. Just put it at that. I get tons of emails from people saying, you mentioned this because you're getting paid. Listen, I don't need, I don't get paid for it. So download this app. It's called Hotel Tonight, and it's only for last minute bookings. So if literally you need a hotel room in like 20, 30 minutes or the next day, that is what the application is for. And the application, or the company, Hotel Tonight, searches all of the surrounding hotels in Manhattan. And they look at the vacancy rates of the hotels, and they say, okay, if we can get this guy or girl to book a room, could you give him a discounted rate? So you can get hotel rooms in Manhattan for like $100. So if you're in a bind and you're stuck in the city, download Hotel Tonight, and you could actually get pretty decent hotel room for around $100, $200. That's the tip of the night. We are going to be walking directly down 7th Avenue. We are crossing 54th Street. We're going to be walking through Times Square tonight, which is definitely not in character for us here in the stream. Hey, Keith says, Tom, does the Long Island Railroad run 24/7? So it does, but after midnight, the trains run every 2 hours. So let's say if you're in the city late, meeting a client, and you miss your 1 o'clock in the morning train, well, you don't want to wait till 4 o'clock in the morning in Penn Station, let me tell you that. So yeah, Hotel Tonight is a pretty good service. I've used it many, many times. Now, the only times I really use it is when we have these massive snowstorms in Manhattan. Let me actually cross the street to show you guys an interesting building here. So sometimes when we have these massive snowstorms here in the city, they'll actually suspend the subway and the LIRR train service. So if I'm at the office and they suspend the LIRR, I'm like, oh my God, I'm going to be stranded in the city. So I just wind up staying at a hotel, which it's pretty affordable if you use Hotel Tonight. Speaking of hotels, this is the Sheraton, New York. This is another hotel that was recently renovated, I think during the Big C pandemic. It's really beautiful inside. But the reason why I crossed the street, team, is I wanted to show you this building. You see this building right in front of us? This is Barclays Investment Bank. Now, this is a major, in my opinion, historical building as it relates to the financial markets, because if you've ever watched any of the old CNBC or Bloomberg or Fox Business footage of the great 2008 financial crisis, where you saw all these videos of investment bankers walking out of their office holding cardboard boxes. It was shot right here. This was actually the old Lehman Brothers. And as a part of the deal, right, we won't go into too much detail tonight. We just don't have time. But it is now Barclays. Barclays took over the property after Lehman Brothers went bankrupt in September of 2008. And that really kicked off the financial crisis, right? Lehman Brothers going under. It happened right here, just north of Times Square. Hey, Mike C, what's up? This is $2,000 suits walking out with boxes. Yeah, I mean, Mike, you're right. And it's such crazy footage, really, really crazy footage. If you just pop up another YouTube browser and you type in 2008 Lehman Brothers, you'll actually see some of the footage. Now, 7th Avenue, where we are right now, this is actually another investment bank, and this is a French investment bank. This is called BNP Paribas. And not too long ago, and you guys probably are not even going to believe me, there was actually a helicopter crash right on the roof of this building. And it was actually almost on a day like today. Very much overcast, this really dreary, miserable, gray New York City day. And unfortunately, a mini sort of like helicopter crashed on the roof of the BNP Paribas, and they actually evacuated some of the surrounding buildings. I was actually in the office that day. I worked out of the Marsh McLennan building, if any of you know what that is. Peter, I have not watched Trading Places, but that is on my to-do list. I've gotten many, many recommendations about that. I'll give you guys one more shot of BNP Paribas. Jonathan says, wow, I didn't know that. That's very interesting. Good to see you, Jonathan. Beacon, New York. Good to see you, my friend. Thanks for being here. So, Toll Brothers, in this environment, guys, right, you would think, and let me just preface this by saying this. It is consensus on Wall Street and on Main Street that the housing market is going to have some cataclysmic crash, right? I'm on Twitter a lot, and almost everybody is saying that. Now, I agree with the sentiment, right? If you think about, if you ever heard the old saying that the housing cycle is the business cycle, that is true. And housing and real estate market literally is dependent on rates, because not everybody, but assuming the vast majority of real estate is purchased with debt, and the debt market is all about interest rates. So the theory there is, if prices are elevated and interest rates are simultaneously going up, that is going to price a ton of people out of the market. So in order to meet that equilibrium, it's either rates are going to have to come back down, which I don't think that's going to happen, or real estate prices are going to have to come back down, right? So what's interesting about Toll Brothers' earnings report is that it was actually a pretty decent quarter, and the CEO actually came on the call and said, surprisingly, demand is actually picking back up. And here's the thing. Last month, the CEO of Toll Brothers said that, well, he was referring to this past week, so the week before the earnings report. He said this past week, we had the most deposits we have seen in a month, even though interest rates have actually moved back up. So people are actually starting to put deposits down on new homes. Now, I do want to preface this by saying, if you think about the clientele that Toll Brothers serves, right, I would say this is more of the upper echelon of the new home sales market, right? Toll Brothers tends to serve not extremely ultra high net worth, but I would say the upper 25% of the market, luxury homes. And this actually makes sense, and I actually believe the CEO, because if you think about the clientele who is most rate sensitive, okay, it is people in the middle class and the lower class. Chances are, if you are the top 25% of income earners in America, or you hold the top 25% of wealth in America, well, maybe this economic environment isn't impacting you that much. And demand, wow, this is actually a really beautiful view of Barclays. And demand is not going to crater as much as the lower parts of the market. However, if we dig down further into the earnings report and actually look at the data, one of the things that I always like to look for, whether if Toll Brothers is reporting earnings, whether if it's KB Home or any of the major home builders, right, for new homes, I always like to look at the metric of net signed contracts and compare them to the previous fiscal year. So Toll Brothers actually reported 1,461 net signed contracts in Q1 of 2023. Now, if we compare net signed contracts to the same quarter last year, so fiscal year 2022, I mean, it just is an absolute catastrophe. Talk about falling off a cliff. This time last year, Toll Brothers signed 2,929 contracts, okay, as opposed to 1,461. So again, sales transactions are starting to fall off a cliff and really, really seriously decline here, but we're not really yet seeing the crazy amount of, I should say, price decline activity that we should be seeing. And consensus on Wall Street is that it's just because of inventory. We still have relatively low inventory. I don't know, what do you guys think? Hey, Mark is here, good to see you. Welcome, Mark. We are now at 48th Street, West 48th Street at that. If you look all the way down, you'll actually see the ball that they dropped on New Year's Eve. Dan is here, says, I do believe demand will be lower with high interest rates, but prices will be driven up by inflation, says Dan. PJL. Why are you taking walks in New York City one week, then the next week you are in Miami out walking around? You are not one of them drug runners, are you? We'll go ahead and block you. The Papa Smurf OG, good to see you. Says, good evening, Tom. It's been a long time, my friend. I've been working 15-hour days at the FTNY. Wow. Great stream as usual. Big shout out to everybody in the FTNY. Love you guys. And thank you for joining Walks on Wall Street tonight. L, the original, says interest rates are going to keep going up, sadly. I probably agree with you. I think you're right. Julia M says, Tom, my friend makes high-end furniture for restaurants and large homes, and he says business is booming. Wow. Yeah, and I mean, so Julia, that's a really interesting comment. That's a really interesting comment. And it sort of goes along with my main thesis that, unfortunately, the Federal Reserve has really, in my view, has either already made or in the making of a two-tier society in the United States. I like to call it the culling of the middle class. And this has been mainly done by artificially suppressing interest rates, believe it or not, over the last 14 years. Because if you think about savers, usually in America, we reward people for saving their money. However, over the past 14 years, interest rates have been extremely, extremely suppressed, which forces people into the marketplace in search for yield. And this causes rampant speculation, not only in the equity markets, but also in the real estate market as well. Now, here's the thing though. If you think about inflation, I think the number one thing we need to talk about is asset price inflation over the last 14 years. And if you look at the statistics and you look at the data, the top 5% of Americans own 90% of all of the wealth in the country. That means the equities, the real estate. So you only really had participation in a big wealth creation event with, unfortunately, the very high and ultra high net worth individuals kept getting richer, and pretty much everybody else was hard to keep up, right? So maybe this is why we're starting to see companies like Toll Brothers say, look, despite interest rates continuously going up, we're actually starting to see increased demand in the marketplace, and within the past week, we actually had our highest contract signatures in the last month. Kind of interesting. Hey, Dusty Cole is here. Good to see you. Liz Hatch says hello, everybody, and happy hump day. Welcome. Thank you for being here. Arsenal Fan 13 says, I think demand will be concentrated in certain income segments, but I think it will be a while before we get to see impact of excess housing supply. Price action won't be immediate, in my opinion. Yeah, I mean, I think you're right, because there's another economic indicator, right? And I like to call it a leading economic indicator that I like to look at, and it is housing starts and permits, right? So if you want to forecast supply of new homes, right, new inventory, well, one of the things that you should look for is housing starts as well as permits. Builders aren't going to put in for new permits if they don't think there's going to be demand, or if it's expensive, or if there's, you know, a lot of rules, regulations. And we've actually experienced underbuilding in the United States. So I don't know. I think there needs to be a specific catalyst in order for tons and tons of supply to start to come in on the market. Now, to be fair, yesterday in the existing home sales report, inventory did tick up. There's about 2.9 months of supply on the market, just over 900,000 units on the market. So inventory did pick up. Now, is that trend going to continue? It should. But again, I don't have a crystal ball, so I don't know. If you look right here, you could actually see the Empire State Building right through the H&M building here. Guys, I don't know if you could tell, but it is 34 degrees out and a little bit windy, and I'm actually shivering, man. I gotta warm up. I gotta do some jumping jacks or something. I'm shivering. I'm used to being 85 degrees and sunny in Miami. Dusty Cole says the bottom 40% of the country owns 1% of the nation's wealth. Yeah, it's not, yeah, exactly. Dusty Cole, you're 100%. You're 100% right. So even though since the lows of 2008, the stock market has more than tripled, the middle class really didn't benefit all that much if you look at the data. Hey, Paul is here. Thank you so much, Paul, for the $2 donation. Very, very kind of you. This is good evening, Tom, and I appreciate your live streams. Well, Paul, thank you so much for your generous and kind donation. And welcome to Times Square. If you see this little teeny bright orb here, that is actually the ball that they drop on New Year's here at Times Square. Onyx 9 is here. Welcome. Richard Vogel says quite a few people out here tonight. Jafet Perez says Nvidia earnings were also good today. Yeah, so who else reported today, everybody? Toll Brothers reported, Wingstop reported early this morning. Now, Wingstop I think we need to talk about because I am covering this stock, okay? And if you want to play on the thesis that the United States is going to fall into a recession and, you know, all of that, usually what happens during recessions is Americans are attracted to, it's something called simple luxuries, right? And that's why we talked about, you know, Elf Beauty, we talked about Ulta Beauty, but also a lot of the quick service restaurants or the QSRs tend to do really good as well. Now, I haven't really seen any Wingstops here in New York, but I've seen many of them in southern Florida and in my community in North Miami. And let me tell you, every time I walk past the Wingstop, in Miami at least, it is always packed, always. So Wingstop reported earnings today, and earnings absolutely exploded, up 155%. EPS came in at 59 cents. Revenue was also up 46% on $104.9 million. Now, Wingstop is a franchise, so if you think about the growth trajectory of Wingstop, I think the company I would probably model it after is that of maybe a Dunkin' Donuts. Now, Dunkin' Donuts actually used to be a publicly traded company, if you guys remember correctly. It used to trade under the ticker symbol DNKN. But Dunkin' Donuts is no longer public. So I think Wingstop is one to watch. Gross margins are actually very high relative to other companies in the industry and the sector. So good quarter all around. Has anybody here been to Wingstop or could provide any insight on whether you think the restaurant is good? Because as Peter Lynch always says, the best form of market research you could do is just going to the mall with your family and your kids, paying attention to trends, what people are eating, what people are wearing. And since we have, 300, 400 people in the chat, whatever it is, anybody been to Wingstop? Any thoughts on it? Good, bad, ugly? What do you guys think? Hey, Michael Joseph says, Tom, the food there is pretty cost effective. In New York City, it's like $8 for a decent wing meal, says Michael Joseph. Ryan Beck says, that's interesting. They must have a smoking deal with the suppliers. Something must be going on because over the last quarter, there was a shortage on chicken. Does anyone remember that? And everybody was saying that it was due to this bird flu. Nako says, Wingstop is okay, but they take forever to give you your wings. L the Original says, Wingstop and Buffalo Wild Wings are trash. Andrew says it's okay. So it looks like the chat's 50-50. Keith says Intel announced they will run negative for the next 2 years. I have a big problem with Intel. I don't know if I told you guys the story of why I'm not a big fan of Intel, but maybe I could tell it another night. Hey, Anderson says food inflation may have put margin pressure. That's another good comment. Wow, KMMP76 says Keith Lee blew up Wingstop on social media. I don't know who Keith Lee is, but let me take a screenshot of that and I'll research that once I get on the Long Island Railroad. Oh no, it's the CD guy. We'll go this way. Jafet says Wingstock is $179 a share. Yeah, well, the stock is trading near 52-week highs. Now, here's the thing. I think this is a very teachable moment here because, a lot of traders and a lot of investors, what they do is they try to look for companies that have increasing earnings, right? We always talk about 25% EPS growth quarter over quarter, 25% plus revenue growth quarter over quarter, really good pre-tax and after-tax margins, and about 25% plus return on equity, or ROE, right? However, the general market conditions really trump everything else. And what I mean by that is if you're trying to buy a breakout, right, after earnings, and the overall general market is rather crummy, like the market that we're in now. We're sort of in this sideways, choppy, bearish pattern, especially as it relates to the S&P 500 and the NASDAQ. A lot of those big earnings beats, these big gap and goes, are going to fade throughout the day, and that's exactly what happened with Wingstop today, and that's exactly what happened with Palo Alto Networks. Now, Palo Alto Networks reported a stellar quarter yesterday. I think the stock was up 10% after hours, but it closed mid-range on the day today. Now, if they reported that quarter during a raging bull market in 2021, that thing would have gapped and gone straight to all-time record highs. But what's more important than the individual company's earnings in many cases is the overall general market trend, right? If you look at the data, about 8 out of 10 stocks generally tend to follow the overall trend of the broader market. So if you're trying to go long individual stocks on earnings into a bear market, your probability, your odds of success are significantly deteriorated. So it's a good point. Jeff W277 says CNBC reported that airfare is one of the top items for inflation. I don't see that. Last night I got a ticket from New York City to Detroit for March 15th. Baggage fee $46. Actual ticket was $26. Wow, man. Jeff, where are you buying your tickets? Because I want to know where you're buying your tickets because I'll give you some insight on what I'm experiencing. My personal inflation rate on airfare is 100%. Well, that's not true. It's over 100%. It's like 120%. This time last year, as you guys know, I would buy my tickets from New York City to Fort Lauderdale or Miami International Airport. It'd be like $77, if that. Now, they're like $130 to $150, sometimes $170. Huge increase. So I don't know, maybe you just got a good deal, but I'm getting banged on the airfare. Hey, Western Mass Dave is here. What's up, Dave? Welcome to Times Square. You guys never thought you'd see me here, but you know, today I was having a good day, so I have the mental fortitude to struggle through Times Square. And it actually looks really beautiful tonight with all of this overcast. It kind of looks like Gotham City. Mike C says used to be able to use 25K miles for a round trip ticket. Now it's 70,000 miles for the same trip. Wow. Oh, Jeff W277 says it was Spirit Airlines. Yeah, I mean, I have one rule, and I think you guys know that. Now, in no way, shape, or form am I, you know, you guys know me, I don't really spend money like crazy like that. I'm not materialistic, but I do have one rule. Actually, I have two rules. I will never fly Spirit Airlines, and I will never take the Megabus or the Greyhound bus ever again. I just can't do it. I used to take it all the time when I was younger, and I just promised myself I can't do it. I can't do it anymore. Beautiful American flag here. Hey, Bill. Says Pitt to SFO has stayed around 350 for me since 2017, says Bill. Yeah, I don't know why. And so this is weird because I think JFK to Miami is one of the most traveled destinations in the country in terms of flight frequency. So you would think it would be relatively cheap because they could fill all the seats. I don't know. All right, everybody, if you direct your attention here, you'll actually be able to see One Vanderbilt. Looks really beautiful tonight. Hey, Bree Grams is here. Says, what is the Megabus? So the Megabus is a very affordable bus service that'll take you pretty much anywhere up and down the East Coast. And I used to take it all the time because I didn't have a lot of money. And you can sometimes get tickets for as low as like $8 to take you from New York City to Washington, D.C. But it's a horror show. It's horrible. And I've never had a good experience on the Megabus. The bus breaks down. You know, there's people screaming, there's people fighting, and I just can't do it anymore. Michael Joseph says, Tom, I took the Greyhound from New York City to Chicago once. Craziest experience ever. Wow. People on the back of the bus were smoking weed and drinking booze all night. Yeah, that's what happened with my Megabus. And the bus broke down. Everybody had to get off on the side of the road. It was pouring raining, okay? Pouring raining. We had to wait for another Megabus to pick us up. We got on the bus. We drove about 30 minutes and that bus broke down. We had to do the same thing again. And guess what? For whatever reason, the other bus that came to pick us up said, you know what, guys, we apologize for the inconvenience. We actually have to take you all the way back to New York City. So we literally just did like a 3-hour drive around for nothing just to go back to the Jacob Javits Center. So yeah, I don't think I'm ever going to take the Megabus again. Hey, Sabrina Fair, what's up? This is Tom. This sounds like the plot of What Happened One Night. Yeah. Hilarious. Chad says, yeah, the Megabus has no terminals. They use roadside bus stops. Yeah, so in New York, you get the Megabus right outside the Jacob Javits Center. You know, actually, let's walk down here to 6th Avenue so you guys could see a pretty good view of the Empire State Building. But you're right, yeah, there's no terminal, so you're just waiting outside on 10th Avenue by Jacob Javits Center. Somebody's saying, Tom, what about Amtrak? Did you have a good experience? I really like Amtrak. I really, really like Amtrak, but I really never have any reason to take the Amtrak anymore. As you guys know, I used to take it to Philadelphia. I took it there once, but I didn't have any problems. I liked it. All right, team, this is BMO Capital Markets right here. This is also where you have the NASDAQ. 151. But we are actually going to be walking up to the Bank of America Tower, which is on your left. To your right is Salesforce Tower. This is Mark Benioff's building. Hey, MBA Elias, good to see you. Thanks for joining us. Trust you're well. One of the things that we haven't covered in a while, everybody, is precious metals. So let's talk about the action in the precious metals market. Gold is trading at $1,828 an ounce. Silver is at $21.62. Now, it's interesting because you would think, well, let's actually play devil's advocate a bit, because I know we have a ton of gold bugs in the chat. We have a ton of people that are huge fans of precious metals and the like. So if you think about the action in the dollar over the past, I don't know, 3 or 4 months, we've actually put in a significant top in the dollar. And you would think that since the dollar is coming down, now over the past 2 days we had a little bit of a bounce in the Dixie. I think the Dixie's at 104. You know, you would think you would have this really big monstrous run in gold and silver. Now we did get a little bit of a bid in both gold, silver, and the digital gold being Bitcoin, but hasn't really had any staying power. And if you have TradingView, right, so you guys can see a visual. Speaking of a visual, look at this visual. This is the gorgeous Empire State Building. But if you have TradingView, it's really helpful if you type in, and you could look at the ETF for gold, right? You could look at the paper. GLD, ticker symbol GLD, and go to a monthly time frame, okay? And what you'll see is this absolutely massive cup with handle style pattern happening on gold, but we've never really gained any traction. You could say it's forming a handle maybe, but you know, in my personal view, I would never really get involved in gold unless we crack new all-time record highs. And I'm going to give you a reason why I don't think we will. And the reason for that is because if you look at the CPI report, the most recent CPI report, rather, that we just got out, annual CPI came in at 6.4%. Now, on a year-over-year, I should say a month-over-month basis, the trajectory for inflation in the United States is down. It's actually going down. So the main thesis, right, everybody says to buy gold, silver, even Bitcoin, is for an inflation hedge. Well, if you want to be serious and look at the data, inflation is, to be honest, coming down in the United States. Now, this most recent CPI report that we got out, the weighting has changed a little bit, right? So the calculation, how they calculate CPI, has now changed. So the main component, which is about 44% of the CPI, is now made up exclusively of shelter costs, right? And much of that weighting of shelter costs is made up of owner occupancy rent, right? So what you could rent your home out for if you own it. And again, yesterday we talked about existing home sales. Today we talked about Toll Brothers. Home prices are not really coming down as fast as we would like. It's not to say that they're not, but almost every single other metric of the CPI, including used cars, new vehicles, they are coming down, but it seems like the only things that are a little bit sticky is shelter, food, and energy. Now, in 2 weeks, the futures market is pricing in a 24% likelihood that we are going to get a 50 basis point rate hike, right? Today we got the Fed minutes out from the last meeting, and there was actually a couple Fed members that were actually pushing for a 50 basis point rate hike. So all of the different catalysts are in place for this housing market to continue to cool, right? I think everybody, well, maybe not everybody in the chat, would agree that interest rates are still going to go higher for longer, right? Futures market is saying that, all the Fed presidents are saying that, and being that real estate is essentially dependent on rates because so much of real estate is acquired with debt, and debt has a price, and now the price of debt has gone skyward. If we think that if we know that the CPI now is 44% weighting to shelter costs, well, if we really have big deceleration in housing prices, the CPI could, in theory, really fall off a cliff here and really start to have this disinflationary environment that the Federal Reserve keeps speaking about. But I don't know. What do you guys think? Michael Joseph's Fed minutes today shed some light on it. Indeed, it did. Anderson says, Tom, FOMC members are just scary, or just scaring the markets because it's ignoring them. That's possible too. Top G says, Tom, they aren't being aggressive enough with rates, in my opinion. Abdullah says, I agree. That is right. It is Ash Wednesday. Mike C says, Tom, CNBC's Michael Santoli was still assuming only 3 more 25 basis point hikes until the Fed is done. Is that more wishful thinking? Well, it could be possible, because let's say we get another 50 basis point rate hike, right, next month. Then the only thing that we would need is another 25. And, well, okay, I'll sum it up like this. Existing home sales, guys, have declined for 12 straight months. A year of consecutive existing home sales declines. I mean, transaction volume has literally ground to a halt, right? I'll read this excerpt from Toll Brothers earnings again today. Toll Brothers reported 1,461 net signed contracts this quarter. Their net signed contracts this time last year was almost 3,000. So cut in half, right? So we're seeing sales transactions in existing home sales and new homes literally cut in half. So even if rates move up another 100 basis points, you know, maybe that will get cut in half again. I mean, it's just so strange. I mean, something has to give. And again, we sort of go in this circular argument that, you know, the only thing that's sort of propping the housing market up is there's just really no supply. There's really no inventory. And there really needs to be a catalyst to bring some inventory onto the market. But again, I don't know what that catalyst is going to be. Hey, TCs is the most important thing to remember is rates will not be going down for a while. Yeah, I think Neil Kashkari said something very similar, that he could probably leave rates elevated for multiple years. Anderson says, today the market for the first time is pricing ahead of the Fed for 2023. 5.185% versus 5.25% for the dot plot. John says, well, let me adjust the brightness on my camera here. Blues Writer says, I've collected modern gold coins from the US Mint for years because they are actually artistic and cool aside from their intrinsic value. Love that. I wish we could, wish there was a way for people to put pictures in the chat. Hey, Chad says, Tom, the arguments for a 50 basis point increase stem from the concern that there had been a pattern of incoming prices and wage data exceeding expectations, and a risk that high inflation would persist. Well, I think what's really going on, and I agree with you, does anybody remember former Fed Chair Paul Volcker, right? And the drastic measures that Paul Volcker took to crush inflation? And the reason why he had to do that is because previous to him, the previous Fed chair sort of played the fence, right? And raised interest rates and then started cutting too soon. And then we had runaway inflation, right? So I think Fed Chair Jerome Powell and the rest of the Fed presidents don't really want to make the same mistake. They would rather make sure they really kill inflation. And if that means they kill the economy in the process, they'd much rather do that than sort of go half-baked on it and start cutting or start easing too soon. Or maybe just not raise them any more than they already have, right? Which could run the risk of, the markets getting the animal spirits back in again. So, look, there's a lot of people and a lot of fund managers and PMs on Wall Street, especially on Twitter, that say, hey, Fed Chair Jerome Powell is killing the market and he's an idiot and he's got to go. But at the end of the day, I don't really know if I agree with that, because, a lot of the fund managers who are saying that were long a lot of this, high beta, high frothy, growth equities, right? And with the Fed raising rates, those type of companies are the first ones to get absolutely killed and absolutely crushed, right? If you just think about valuating a company's cash flows back to the present day, right? So the value of a company's future cash flows, as interest rates go up, the present value of those companies' future cash flows go down, right? And many of these tech companies that everybody was crowding into didn't have any earnings, right? So, look, I actually wouldn't mind if we go back to an environment where you could leave your money in a money market account and make 7% or make 10%, right? I think we should go back to maybe rewarding people for saving, right? And not have to go out and speculate and hunt for yield all the time. Man, the wind is so brutal, guys. I'm freezing tonight, man. I am absolutely freezing. Yeah, Ryan Beck says you have delusional sellers too, trying to command the same prices from early 2022. Ryan Beck, I couldn't agree with that more. I mean, you should see some of these listings on Zillow that I see in Miami, right? 3-bedroom, 2-bathroom homes listing for like $740. I mean, to me, that's wishful pricing, right? And here's another thing. And Ryan Beck makes a good point, right? So let's say if we get a nationwide real estate price declines of 15%, right? Everybody is going to start calling Armageddon for that. But think about how much real estate prices have gone up from 2019 until now. It's just been a meteoric rise. So, look, I think at the very least, if we just get a mean reversion move in real estate, the vast majority of people are still probably going to be fine. Now, here's another interesting, and I forgot to tell you guys this. It's so cold today that I can't even think straight. But here's an interesting statistic, okay? And we were speculating this on the live stream for a while. But does anybody want to guess the percentage, okay, of mortgage holders in America that have an interest rate below 6%? And the Toll Brothers CEO actually gave us this data on the earnings report, which I thought was rather interesting. But again, does anybody want to take a guess in the chat the percentage of mortgage holders in America that have an interest rate, 30-year fixed, under 6%? Damn, Ryan Beck, right off the bat, man, 85%, you're right. That's crazy. So think about that. I mean, damn, Ryan Beck knocking out of the park on the first guess. But guys, think about that, right? So the Toll Brothers earnings report, or excuse me, the CEO, he was essentially saying, just on a broader, I would say a broader statement about the housing market. He says, look, one of the things we have to take into consideration here is that out of all the people in the United States, this is the Bank of China, by the way, across the street. He said, out of all the people in the US that have a mortgage right now, 85% of those people have a 30-year fixed rate below 6%. Now, why would that be relevant? Well, we could speculate. Here's why I think that's relevant. If I own a piece of property right now in America and I have debt on it, and that debt is, a 3% 30-year fixed, 4% 30-year fixed, and if I were to sell my home right now, even at a profit, I would then have to go right back into the marketplace where inventory is so low, and interest rates right now, I think the average 30-year fixed rate mortgage is 6.88%, right? So 100% increase from what your rate is. People are saying, you know what? I'm just gonna keep my rate. I'm probably paying $1,500 a month for my mortgage. I don't want a higher payment. The economy's crazy. There's so many negative things going on in the world. I just want to sit tight. And sellers just aren't really coming on the market, right? That could be one of the reasons why we don't have a lot of supply, or not a lot of supplies coming on the market. Potentially. I don't know. Potentially. Hey, Robert Parker, what's up? Oh, really? Robert says, not only is it a cold night, but it is a wet one as well, as more rain will return later on. Yeah, it was raining a little bit, Robert, throughout the day for sure. But thank God right now it seemed to have stopped. Now, this building right here, everybody, this is the New York Times building. And there's actually a very notable technology company that works in that building that has an office there. And they are called Datadog. The ticker symbol is DDOG. Hey, Marcelo Gills is here again, Tom, not expecting. Missing too much. Good to see you, Marcelo from Brazil. Welcome. Gary Carpenter's here, Techno Pink, God bless. Techno Pink is our EY consultant in the group from the Dominican Republic. Always a pleasure to have you here, Techno Pink. Good to see you. Mike C says, to me, once you've bought your first house you're in, from there, yeah, that's true. All right, team, so we are now across the street from Joe's Pizza. This is West 40th Street and Broadway. And this is the H&M building, or I would say the top of it. Jeff says, I own some Datadog. I had no idea where they were located. Yeah, so in Manhattan, their Manhattan office is the New York Times building. Now that's another stock that has been really, really beaten down. Because again, all of those SaaS type companies have gone through a fairly big multiple expansion. Again, due to the interest rate environment, but now that rates are going up, those type of stocks have really been crushed. Jim is here. Says, hey Tom, ironically, the house is a liability and the mortgage is the asset, low percentage. This is Jim. Yeah, I think just depending on how you use the house too, right? I think many people argue, if you just buy a single family home, this thing is kind of cool, and you just live in it, that it is a liability. And I guess technically so, right? Technically so, but if you use the house and maybe you rent it out when you're not there, or you house hack it, I think it is very advantageous for people to start to build a net worth, right? I don't think you should be a renter forever. I don't, but there are times where you should absolutely 100% be a renter. And I think the times in your life where you should be a renter is when you're very early on in your career and you're trying out multiple different things, right? So let's say if you're in between the ages of, when do you graduate college? 21, maybe 21 to 30. I think depending on your career, being a renter is really, really good. Because what if you're working in New York City and then you get a job offer in Dallas that's going to pay a 40% more, new responsibilities, new challenges. Well, if you're a renter, you just up and move. You have no liability, right? You just get out of there. But if you own a place, it can be a little bit harder to have that mobility. So, yeah, I would agree. Renting is good in some cases for sure. Hey, Nina, this is Tom. Renting's still over 6 years. Too costly for me to purchase property. I like to keep my liabilities low. Well, I think now, Nina, we are in, I think I've said this before. Let me try to cross the street here without getting knocked off by one of the food delivery bike guys. But I think we are in an environment where the trade is very asymmetric. There's a lot of asymmetry here. So again, look, I mean, if you're in the market, if you're a first-time home buyer, I think that if you like a specific neighborhood, rent for 6 months, because all of the leading economic indicators are telling us that this housing market, the prices have further to fall. So renting for 6 months, even though you're in the market to buy, is not throwing money down the toilet, right? Because you're using leading economic indicators and you're doing your market research to say, okay, if you look at the average, well, we could actually look at the data, right? Yesterday we got it. Homes are starting to sit on the market for longer, but the average home that was sold in January was on the market for 30 days. That's still relatively fast. I mean, you list a home and in... Yikes. The pizza guy was in a rush. What was I saying? Anyway, look at this. Empire State Building looks good. Man, that is a great shot of the Empire. Oh yeah. So the average home that was sold for existing homes last month was on the market for 30 days. So you list your home on the market and it sells within a month. That's fantastic. That's still well below the norm. But the trend is that homes are sitting on the market for longer. So I would take that bet and say, look, you don't have to rush in and buy something. You could take your time, wait for the right deal. And I think, interest rates are going to continue to go up. I think you may get a better deal maybe Q3, Q4 this year. Matthew M says, Tom, I see more articles with kids moving back in with their parents as they're older. Wow. Hey, Austin City Limits, good to see you, man. Ethan G says, in Toronto, they're getting a blizzard, tons of snow. Well, keep safe to all of our Canadian viewers. I don't know how you guys do it. I'm not a big snow guy, to be honest. Hey, Rat thinks his homes are sitting for 60 to 90 days in the Pacific Northwest, says Rat think. TC says, love your comments regarding random people's actions. Joe Driver says, hello, Tom and team. Front page of the Post today, Hamptons LI trailer park home sells for $3.75 million. Wow. Well, that's probably the land value, right? So, well, again, I didn't read the article, but I'm assuming what happened is they're probably going to build some ridiculous mega mansion on there. Now, I'll give you guys a little bit of an insight for those of you who are not familiar with the Hamptons. A lot of people think the Hamptons is all super wealthy, mega rich hedge fund guys and girls. It's not the case. There's actually some really I would say lower middle class to lower class areas of the Hamptons. for some of the native Long Islanders there. There's a lot of trailer parks, things like that. So maybe it was a buyout for that, who knows. But if you guys are enjoying the live stream so far tonight, feel free to leave a like on the video, hit the subscribe button if you're new, share the show with your friends. Chad's is overpriced houses plus high interest rates equals houses sitting not sold. Agreed, Chad? Agreed. Miller says, hey Tom, hope you're having a great evening. I am, thank you so much for being here. Hey, Jenny Trickett says, yes, and kicking low-income people out of their trailers. They will be put out on the streets. This happened in Colorado. Well, I mean, if the place sold for over $3 million, you know, I don't know if they'll be on the street. But I get what you're saying, for sure. All right, this is the beautiful Macy's at Herald Square. Beacon, New York says there isn't really much to see in the Hamptons. Very boring landscape. I disagree. I love the Hamptons. My cousins used to live in Watermill. I used to love going out there as a kid. It's awesome. It's a really a beautiful place out there. In and around the Hamptons is really nice, but if you want to see something a little bit different, I would go all the way out to Montauk. Montauk is a really beautiful place. It is the furthest out east on Long Island you could go. Yeah, Michael Joseph says Sag Harbor is very nice. Jenny Trickett, you're correct. Yeah, probably the yeah, you rent the land on the trailer park, right? And then you own the trailer, something like that. Jimmy Hook. Wow. Let's cross 34th Street. We are almost to our destination here, team. We'll make a right. Wow, Scott says, my home in Seattle has lost $100,000, 20% in the past year. Home sitting 90 days equals bad market, says Scott. Yeah, so it seems like some markets are getting beaten down more than others, right? And in the existing home sales report, it said exactly that. It said sales are really falling off a cliff in the Pacific Northwest, in the Northeast, but home sales are actually starting to pick up in the South and the Midwest. So I don't know if that's maybe a change due to people just not wanting to live in the Pacific Northwest anymore because it's rainy and cloudy and miserable all the time. And, you know, a lot of tech workers, you know, if you're a software engineer, why would you work up there when you could work, you know, maybe in a place like Texas or New York City or maybe Southern Florida? I think the pandemic has really exposed a lot of interesting things in the way people live. And in the way people work, right? You know, just think about how many people changed the way they fundamentally live their lives due to the pandemic, right? Moving away from cities, maybe to suburbs, moving away from places with very harsh climates to places with more moderate climates, just because they could do their jobs remotely. It's going to be really interesting to see over the next 2 to 3 years, which markets declined the most and took the biggest beatings, and which markets actually held up rather well. Because if you look at the data from the 2008 financial crisis, the markets that took the biggest beatings were Las Vegas, Miami, Tampa took a huge beating. Parts of Arizona like Phoenix took really, really big hits in the 2008 financial crisis. And usually the markets that have these huge meteoric rises during the bull markets, they tend to correct and fall the most. And I think during COVID, some of the markets that were the most white hot was like Miami, Palm Beach, Boise, Idaho was a huge market, Denver, Phoenix, Arizona. But you know what's interesting? Toll Brothers reported earnings today, and the CEO said we're actually starting to see a pickup in contracts signatures in Boise, in Phoenix. Some of the parts that suffered the biggest price declines and the demand declines, they're actually starting to see an increased pickup in demand. I don't know, it's kind of interesting. Wow, David C. Randall says, Tom, I am very happy that I was retired during the pandemic. Well, congratulations on your retirement, love that. Uh, 7914 says Boise market is still very, very high. Susanna Q4 says after the pandemic started, the nomad work culture. Like, I agree. Jeff W277 says after the slamming of California, Elon Musk just announced a big engineering building in California, not Texas. Can't Elon tell them to move to Texas? I have no idea. I didn't even see that. I'm gonna have to do some research on that.
Yo, give me 500 motherfuckers.
Dr. Longest, good to see you. But team, I gotta boogie out of here. We are now here at Penn Station. We will be live tomorrow, Thursday. Hopefully I'll have some warmer clothes on tomorrow. I'm freezing. I think I'm getting a little bit too adjusted to Miami weather. It's only 34 degrees out, but I am freezing cold. Beacon, New York says homes up here in Beacon are like New York City prices still. Wow. Yeah, I mean, that's a good point. A lot of people started to leave the city and go to places like Westchester, upstate New York. You know, I mean, if you have to go into the city only maybe 1 or 2 days a week, you know, maybe buy a place in Westchester, maybe buy a place, you know, on Long Island, something like that, and commute in. But, you know, you're starting to see demand come back into the city. You know, all those people that bought, you know, in the suburbs, they're coming back. I could tell. I mean, I could tell the city is a lot busier than what it was in the pandemic. But team, it's going to be a short stream tonight, about an hour. I will see you all tomorrow. We'll have a lot more stuff to talk about in detail. We only covered a little bit tonight. But thank you for coming out. If you're new here, please subscribe to the channel, hit the like button if you enjoyed it, and I will see you all tomorrow. Melissa2087, thank you so much for joining. Joan K, Dr. Longas, Mike Skate TV, Gary Carpenter, thank you so much. The LT Prod, appreciate you. Ratthink, thank you so much. Western Mass Dave, Michael Joseph, Abdullah, and to the Mighty Bull, have a good night wherever you are, because there's always a bull market somewhere. You just need to know where to look. Marcelo, Susanna Q4, 45, thank you so much from Canada. Keith, and we'll see you all tomorrow.